I'm Ron DeLegge with ETF Guide TV, and we're pleased to have with us David Mazza with Direction Investments. He's Managing Director and Head of Product. Dave, always great to see you again.
Hey, thanks for having me back.
So as you know, the Dow Jones Industrial Average just had a major shakeup in its holdings. The Dow is really less of a true index and more of a barometer. Anyway, tell us about what got added and what got deleted and what are the major impact for investors.
Yeah, you're absolutely right. The Dow, compared against other indices, but it's called average for a reason, right? So when Charles Dow was creating this, you didn't have market capitalization data. All he had was price. So that's how it's weighted. And with Apple doing its recent split, the Dow got a shakeup. And I think the biggest story is the introduction of a company like Salesforce, which, as we certainly know, is sort of at the tip of the spear of how the technological economy that we live in today operates, is being added, but ExxonMobil is leaving. And ExxonMobil is actually one of the longest standing. Its predecessors actually make their way to really, in many ways, the introduction of the Dow. And energy now, which we know has been under pressure, only Chevron's in there, 2% of the index, but tech, over 20%.
Pretty amazing shift that we're seeing, and that's really probably a reflection too of what's happening economically, throughout the entire globe, not just the U.S. Now let's talk about another major economic development and really a big trend: the connected consumers. And Direction just launched the Direction Connected Consumer ETF. That's ticker symbol CCON, and it's your latest ETF launch. So tell us more about the investment thesis behind digitally connected consumers.
Yeah, that's right. We launched ticker CCON, or CCON as we call it, very recently. And what it's intended to do is capture the fact that as consumers, we're evolving. And we've been evolving for years because of the ability and new technologies that allow us not to require not to require in-person experiences, but can able to do that virtually. And I think immediately we think about online retail, which we know is now 27% of total retail sales. But it's much more than that. It's actually, how do we entertain ourselves? So we know that, the growth of streaming and e-gaming. How do we keep ourselves healthy? The growth of remote wellness, companies like Peloton, companies like Teletalk. It's also, how do we stay connected with friends and family? So we know social media, and then the other connectivity tools like a Zoom video that allow us to connect in unique ways. And then lastly, which is more nascent, it's online education. So this involves companies that not just empower the ability for traditional school, like K through 12 or college, to happen virtually, but also companies that allow workers to upskill or reskill themselves in an evolving economy. So CCON really captures, in our opinion, the 40 stocks that are emblematic of the evolution that we're seeing as consumers across the board.
Now let's talk about something you said recently on your Twitter feed. Quote, if this is the tech bubble 2.0, we may still be in the early days as opposed to the end. And the bubble, or whatever you want to call it, it's been good to tech-focused ETFs like CECL, SOXL, TAWK, also CWEB, which focuses on Chinese internet stocks. So how long does this bullish run continue?
Yeah, no, that's absolutely right. I think that was sort of said in jest, but as we know, we've been in an environment where tech has done well for some time, but partially because of the splits that we're seeing out of companies like Apple and Tesla, also the introduction of CRM to the Dow. I actually think now is where we're truly maybe getting into an environment where we could see a significant run up that maybe is not justified by fundamentals, but you're absolutely right. Many of our leverage ETFs have done exceptionally well in this environment for traders taking advantage of the moves in tech. I think, again, until we really have more certainty on the long-term economic recovery, and by that I mean more of a return to normalcy, tech still has a lot of opportunities to continue to push higher. The earnings that we've seen out of these companies have, in many ways, justified their valuations, and they've beaten analyst expectations that actually were boosted. So I think we're in an interesting environment. Investors should be cautious and have the potential to be nimble, but there are technologies, whether it's tech companies that are empowering the ability for folks to work from home, or the technologies powering the ability for consumers to be more connected than ever, that are likely going to continue to benefit in this environment regardless of if there is a vaccine available in a real immediate term for COVID.
Dave Mazza with Direction Investments joining us. Now, the performance gap between growth stocks with growth outperforming effortlessly, it seems, value has really been an incredible and an astonishing development here in 2020. And you've got the Direction Russell 1000 Growth Over Value ETF, that's ticker symbol RWGV, which has surged almost 70% year to date. Now, its counterpart, the Direction Russell 1000 Value Over Growth ETF, ticker symbol RWVG, has slumped around 15% and lagged tremendously. So it seems like investor sentiment towards value stocks is really soured, but sentiment is, as you know, is in constant flux and can change on the dime. How do you see it?
Yeah, it's really interesting. We've seen some fits and starts this year where growth does begin to sell off and value does exceptionally well for 1, 2, 3 days. But that's all it seems to be able to manage in this environment. And growth stocks continue to outperform value. So we've seen RWGV, which actually gives 150% exposure to growth stocks, balanced with a 50% short to value stocks, do exceptionally well for investors. And of course, its counterpart, to your point, do not so well. But again, we know that value stocks are attractively valued relative to growth, but until we see some, I think, sustainable momentum in those names, coupled with more positive analyst recommendations and calls on some of those value stocks, which are dominated by energy and financials companies today, yeah, I personally think it's difficult for value to see a sustained run. With that being said, when we do see that, it's likely going to have some of the best performance that we've probably ever seen in the history of value indices. Yeah, great points that you make, and especially on the sector front. Really, when you look at the two camps, it's really a sector story. Correct. Now, let's finish off with one last thing before you leave us. When market conditions get rough, ETFs like SPDN and TMF have really been not only great hedges, but star performers. And TMF, it's incredible to me that this ETF, for all the chaos and craziness we've had in 2020, TMF has yet to turn negative all year long. I mean, that's just an impressive feat given the chaos that we've had this year. So what do investors need to know about these two ETFs? Yeah, well, it's important for investors to know that those provide inverse exposure. So SPDN, to your point, is about intending on a daily basis to provide the inverse performance to the S&P 500. That's a fund that has seen exceptional growth this year, as on one hand, investors have been very bullish on the markets, but on the other hand, if you are active in your portfolio, there's a lot of opportunities for hedging when you see those down days. So we've seen SPDN and other funds like that really grow significantly, even as the market, sort of to your earlier points, has seemingly been in a relentless run, grinding higher every day. And then TMF, tell us a little bit about that one. Yes, that's focused on the Treasury market. So TMF, to your point, gives amplified exposure to Treasuries. That's another fund where we've seen investors move into and use tactically from a trading perspective in their portfolios as volatility in Treasuries had come down. But we know with the recent announcement from Chairman Powell yesterday, volatility in the Treasury market might start actually increasing pretty significantly, and investors weigh this balance toward how far is inflation going to be allowed to run relative to where kind of rates themselves want to go, because as we know, there's still a lot of uncertainty in the broader markets. So even as equities have run, people have been buying bonds, and so it's a really kind of interesting dichotomy that we're seeing. So again, for traders who want to take advantage of what might be happening in the Treasury market, TMF is an opportunity for them. Well, we appreciate your insight as always, Dave, and looking forward to catching up with you again very soon. Thanks for having me on. I'm Ron DeLegge with ETF Guide TV. You just heard from Dave Mazza at Direction Investments. Thanks for watching.